Hey there. If you currently own a home with one of those fabulous 3% interest rates and you're thinking it might be time to make a move, you're probably wondering if it would be better to buy now or wait until those interest rates come back down. Spoiler alert, the answer is probably no. I'm Susan Cassidy with Coldwell Banker, and I recently had the opportunity to sit down with Scott Dana from Guaranteed Rate Affinity and discuss this exact question. A 25-year veteran of the mortgage industry here in Connecticut, Scott has been a friend and colleague for many years, and I always find his insights interesting. I hope you do too. All right, Scott, so for those folks who are sitting at that, magic number 2.25, or at least anything under 3, or even a little over 3, I mean, that's a great rate.
Yes.
How did we get there?
We got there because of the last 14, 15 years of some not so great things that have happened in our country's history. We started with a housing bubble.
I remember it well.
That was followed by a financial crisis. Coming out of that, we had a great recession. As that seemed to be getting better, there was a second little double dip recession.
Right.
And then we had what everyone talks about, the 100-year pandemic, something that we don't per se want to see happen again.
Right.
In fact, we don't want to see any of those things happen again. So because of all that, the government did a lot of artificial pumping down. Stimulus packages, quantitative easing, buying our own debt, to keep rates and affordability down. And now we've seen a swing to the opposite direction.
So the good news is we're in a much better position economically in this country. Therefore, the need to keep those rates artificially low
has subsided.
And the alternate economic situation of inflation
has reared its ugly head
Right.
to the point of something that we haven't seen in almost 40 years.
Right.
So the pendulum has swung from one side to the complete other side.
Okay. Well, thank you. I think that helps give us some context.
Right.
All right. So, Scott, we talked historically about where rates were and how we got there. Now, could you talk me through where we are now, what we anticipate happening, and how well can we predict what the future is going to look like for rates?
Right. So today, rates on average, depending on your credit score, your down payment, type of loan program, you're in the mid to upper 7s.
All right.
Right. So let's just say 7.7.
Okay.
Right? A far cry from people who are around 3 or under. Right. And what people, so-called experts were predicting in the fourth quarter of 2023 is that rates had gone higher than we'd seen in 20 some odd years, and they were going to go down.
Right.
The economic factors of inflation were seemingly getting better,
Right.
which would, of course, mean rates would come down. Those predictions have fallen on deaf ears as far as the economy has gone.
Yeah.
Because the reality is that here in the first quarter, mortgage rates, after there was a slight dip at the tail end of 23, have gone up again. Now, we're not quite to the highs of the, say, Halloween period of 23, but we are definitely at the highs of 2024, being in those upper 7s again.
So what you're saying is that the economy and interest rates are a lot like trying to parent a teenager. Every time you think you know what they're going to do, they do the exact opposite.
Correct.
Okay, gotcha.
Yeah,
That's an analogy that makes sense to me.
And the prediction, anyone can predict anything, but personally, my crystal ball is completely broken these days. I don't know where rates are going to go. Do I think they will go down? Yes. When? And that's the question I get all the time. When?
Right.
We don't know. That's nothing that any of us can control. The thought process of it's going to be higher for longer, meaning rates, is definitely in play.
Okay.
But keep that in mind, grain of salt, higher when you're at 3 is 4. And are we ever going to even get back to 4?
Right. No.
Probably not, to be honest. Not after we discussed earlier the economic factors over the last 10 to 15 years that got us so low to begin with.
Right.
So if you look at a time frame of, say, the next 12 months to the next 36 months, rates should slowly, gradually go down. How low? That's just not an answer that anyone can really pinpoint.
Okay.
We can't control it. We don't know for certain.
Okay. Well, thank you. That helps. History is interesting, isn't it? Scott is telling us that those uber low interest rates were not only a gift out of a dark time, but probably a once in a lifetime gift. Now, I can predict your question even before you ask it. Even if rates don't go back down to 3%, every little bit is a savings, right? I mean, even if they only go down to 6% or 6.5%, that's better than 7.75%, right? It would be, yes, if the amount you are mortgaging stayed the same. The fact is that with the exception of a couple of blips over the past 50 years, real estate has almost always appreciated over time. And in our local market, we have appreciated over 35% in the last 3 years. And the thing is, no one really expects that to change anytime soon. Now, we of course don't know if the rate of appreciation is going to be exactly the same. It could be more, it could be less. But we expect properties to continue to appreciate, primarily because inventory is still very tight in most markets, and the economic principle of supply and demand is at play. We know that supply is tight, and I can tell you by the number of multiple offer scenarios I have participated in, demand is very high. One more thing to think about. If and when interest rates do start to go back down, that will only ratchet up demand even more, which will make prices go up higher and faster. Okay, so we've talked about the fact that interest rates are hopefully going to ease down slowly.
Hopefully.
We don't know how fast, we don't know how far. We have talked about the fact that we know that property values are going to appreciate. We don't know how fast, we don't know how far. Mm-hmm. We just have history to work with. So knowing that the property values in this market have increased by about 35% over the last 3 years, let's do a specific example.
Sure.
To help answer the question of why we do not think it is a good financial decision to put off buying just because of interest rates. So let's look at a $360,000 house. Mm-hmm. That's the average sale price
in the
area.
Yeah.
$360,000 house. You said interest rates stay right around, we're going to go with 7.7?
7.7. Let's go 7.7.
7.7. So let's assume 10% down. Okay. What would the payment be roughly on a $360,000 house, 7.7% interest rate, 10% down?
Just principal and interest.
Yes.
We're looking at a payment of $2,310.
He didn't just do that in his head. I prompted him ahead of time, just so you know. He's good. He's not that good.
I'm not that good, but I'm very good. I'm not that good.
Okay, so 2310.
Yes.
All right. So let's say if we do quick math and appreciate that 3 years down the road, that property now went from $360,000 to about $486,000.
Major increase.
Major increase. So right off the bat, our 10% down went from $36,000 to $48,000 just to get the same loan to value.
10% down.
10% down. Okay. And let me ask it this way. How low would rates have to go in order for us to maintain that 2310 payment?
And that's the real question here, of course, is why are we waiting?
Right.
We shouldn't be. Because
well, in theory, people think they're going to save on their monthly payment if they wait for rates to be lower.
And this is the practice now of seeing the number. The interest rate would have to go down 2.5%. So you're talking from 7.7 to 5.3 just to get the same principal and interest payment.
Right.
So by waiting 3 years, you got the same payment. But as Sue already mentioned, your down payment's higher. And then there's the things that we know also go up. Cost of taxes, cost of insurance.
Right.
So even if you waited 3 years to go down 2.5%, if they go down 2.5%, which is something we can't control or know, the housing payment itself is probably still going to be even more than if you just bought today.
Right. And if you think about the fact that the value of that home went from $360,000 to $486,000, that's $126,000 in lost equity if you don't buy today. So by purchasing now and letting it grow and getting that equity, you can refinance if and when those rates go down to where it makes it worthwhile, right?
Correct.
You're not stuck with that rate forever.
You can always refinance. It is a myth. Just like it's a myth you had to do 20% down, It's a myth that you can't refinance because there is no such thing as a prepayment penalty in this country.
Right.
Everyone asks me that. The three questions I get the most: what's your rate? How much does it cost? Is there a prepayment penalty? The rate is going to be what the rate is.
Right.
The cost, it's going to vary from individual and specific home greatly based on taxes.
Right.
And then, can I refinance? Can I sell? Can I pay extra? Always. There is never a penalty to do so.
Right. So as you can see, math is math is math. All right. So in our professional opinions, if you are currently in a home with one of those uber low, fabulous interest rates, congratulations.
Yes.
That was a wonderful gift that came out of a terrible time. And I'm glad you have it. I would not want you to use that as a reason not to move forward with what is best for your family today. Well, I hope we gave you some insight and helped to answer that big question. Clearly, we don't see where the math supports waiting, but you have to make the decision that is right for you and your household. I'm Susan Cassidy with Coldwell Banker, and I want to thank you for joining us today. If you found value in our discussion, please show your support by clicking that like button below. And don't forget to subscribe and hit the bell icon so you won't miss any of our future insights on making savvy real estate decisions. Sharing this video with friends and colleagues is the best compliment you can give. And remember, every like, subscription, and share helps us to bring more great content your way. Thanks again for watching. I'll see you in the next video.